Did you know a QDRO, which is the legal way to split retirement accounts, can be signed by a judge and still be rejected by your ex's retirement plan? And if it gets rejected, the money you were awarded in your settlement may not actually be yours yet. Most women find this out too late. In this video, I'm going to show you how a QDRO works, the 3 mistakes that get them rejected, how to verify yours was actually accepted, and one window of opportunity that closes permanently the moment you roll the money into an IRA. By the end of the video, you will know what a QDRO is in plain language, whether yours was truly accepted, and how to check, and the 3 errors that get a QDRO rejected. Also, a little known tax window most women give up without realizing it. Your attorney handled the legal side. This is the financial side, and they are not the same thing. Here's what I hear from women like you all the time. My attorney filed the QDRO. I assumed that was the end of it. That assumption is completely understandable, but it's one of the most expensive mistakes in post-divorce financial planning, because a QDRO has 2 separate stages. The court signs it, that's stage 1, but stage 2 is actually the retirement plan accepting it. The plan can reject it for reasons that have nothing to do with your divorce. If the plan rejects your QDRO, the money stays with your ex in his plan until you fix it. And fixing it takes time and maybe even legal fees. None of this is your fault. The settlement process was not designed to protect you financially. It was designed to dissolve a marriage legally. Before we go further, everything in this video is general financial education. It is not personalized legal or financial advice. I am a licensed financial advisor, but I am not your financial advisor yet. Every QDRO situation is different. Work with a specialist before making any decisions about your specific situation. In the next few minutes, I'm going to show you how a provision in the tax code, Internal Revenue Code Section 72T, that gives divorced women a one-time window to take money from a QDRO settlement without the 10% early withdrawal penalty that's assessed if you're under 59 and a half years of age. Most women give this opportunity up without ever knowing it existed. But before we get there, if you're wondering whether your lifestyle is protected or at risk post-divorce, there's a free 2-minute tool in the description called the Calm Scorecard. Pause the video and take it now, link below. Okay, let's start with what a QDRO actually is. QDRO stands for Qualified Domestic Relations Order. In plain English, It's the legal document that tells your ex-spouse's retirement plan, his 401k, his pension, his 403b, to transfer your share of that account to you. Without a QDRO, the plan cannot legally split retirement assets. Federal law, specifically ERISA, protects those accounts from being assigned to anyone but the original participant. The QDRO is the exception that makes the split possible. Now, here's where it gets really important. The court signs the QDRO, and that makes it a domestic relations order. But only the retirement plan administrator can make it a qualified domestic relations order. The plan has to review it, check it against their specific requirements, and issue a written determination. If the plan says yes, your share is secured. If the plan says no, unfortunately, you are back to square one. Here are the most common reasons a plan rejects a QDRO. Error number one, the wrong plan name. The QDRO names XYZ Corporation 401k plan, but the actual legal name of the plan is XYZ Corporation 401k Retirement Savings Plan for Employees. A few words are different, and therefore the plan rejected it. This happens all the time. Error two, dollar amount versus percentage. The settlement says you get 50% of the account. The QDRO was drafted using a fixed dollar figure, $500,000, let's say, based on the balance of the time at divorce. Markets moved, and now the account's worth $1,200,000. But your QDRO still reflects $500,000 where it should be half of that, $600,000. So you just left $100,000 on the table. So check whether your QDRO specifies a dollar amount or a percentage. If it is a dollar amount, find out what the account was worth on the date that figure was set. Then find out what it's worth today. If there's a gap, that conversation needs to happen before you roll anything over. This may just be a phone call, but if you need to, make it this week. Error 3, missing required information. Federal law requires 4 things in every QDRO: both parties' names, mailing addresses, the exact amount or percentage being awarded, and the time period the order covers. Miss one of these fields, plan will reject it, and you will most likely find out months later. Now it gets more complicated. So here's how to exactly verify that your QDRO was accepted. Step 1, look for a written determination letter. The plan administrator is required by law to send both you and your ex-spouse a written notice of their determination. If you've never received one, that is a huge red flag. Step 2, call the plan administrator directly, not your attorney, the plan. You are the alternate payee. You have the right to ask for confirmation that your QDRO was received, reviewed, and accepted. Ask them to confirm the separate account has been established in your name. Step 3, confirm the amount matches your settlement. Get it in writing. The plan's written confirmation should state the amount or percentage being transferred to you. If at any point you cannot get a clear answer, get a QDRO specialist involved. This is not the place to assume anything. If this is the kind of specific, no fluff financial information you've been looking for since your divorce, hit subscribe. These videos are all built specifically for divorced women navigating exactly what you're going through right now. And if you're realizing your QDRO situation might have gaps, the Calm Scorecard in the description is the place to start. It takes 2 minutes and it will tell you if your lifestyle is protected or at risk. Link below in the description. Now, the piece of the tax code that almost nobody explains to newly divorced women. Again, under Internal Revenue Code Section 72T, when you receive a distribution from a 401k or 403b through the QDRO, you do not owe the 10% early withdrawal penalty, even if you're under 59 and a half. That 10% on $1 million 401k can cost you $100,000. So under 72T, that penalty is waived. Now, of course, you still pay regular income tax, just not the penalty. But here's the part that matters most. This window closes the moment you roll the money into an IRA. The window closes permanently. Once those funds leave the employer plan and enter your IRA, they are no longer QDRO funds. They are IRA, individual retirement account funds. The exception does not follow the money. Most women will roll over to an IRA immediately because they're told to be responsible. But that may not be great advice. World-class advice would be to dial in your cash flows and predictable future expenses. Think vacation, braces, new HVAC, college, and then make that decision knowing the window existed, not find out about it afterward. So before you sign any rollover paperwork, stop. Ask this one question. Do I need any cash now, in the next 12 months, in the next few years? Do I have a clear picture of my existing and future cash flows? Have I built a cash cushion to account for the time when life happens? That's what we help our clients do exactly. This window is not recoverable once it closes. You get exactly one chance to make this decision correctly. Let me tell you about Rachel. Now, of course, Rachel is not a real client of ours, but a composite of client stories. Rachel's divorce was finalized 14 months before she came to us. Her settlement included $580,000 from her ex-husband's 401k. Her attorney filed the QDRO, and Rachel assumed it was handled. When we reviewed her situation, it was discovered that the QDRO had not been submitted to the plan. And it was also never formally accepted. Back up. It was submitted, but not formally accepted. Want to get that right. There was no written determination on file. The money had not been separated into her account. It took 4 months and a refiling to get it corrected. During those 4 months, she had no legal claim to that money. And her ex's investments, which, by the way, were not aligned with her long-term goals, remained intact. The divorce was done. The QDRO was not. After this video ends, find your QDRO documents. Look for a written acceptance letter from the retirement plan. If you don't have one, call the plan administrator tomorrow morning and ask these 2 questions. Was my QDRO accepted? And has a separate account been established in my name? That's it. 2 questions. If the answer to either one of these is no or I don't know, you need to hire a specialist this week. Rachel's name was changed, but her situation is real. And unfortunately, her story is far more common than anyone will tell you. Here's the last thing I want to address before we close this video. It's the words, "My attorney handled it, and I trust it was done correctly." Now, that trust is not misplaced. Your attorney handled the legal side, but your attorney is not responsible for ensuring the retirement plan accepted it, for verifying the calculation was correct, and for knowing about the penalty window under the tax code. That's not what they were hired to do. The financial side of your settlement needs a post-divorce financial specialist. Not because your attorney failed you, but because they are 2 totally different jobs. Complete the Calm scorecard in the description. It takes 2 minutes, and it will show you exactly where your lifestyle is protected or at risk, including whether your assets are actually secured. Link is below. Now that you know what a QDRO is and how to verify it, there's one more asset from your marriage that most divorced women don't know they're entitled to. Your ex-husband's Social Security benefit. If you were married for at least 10 years, you may be able to claim up to 50% of his benefit at retirement without reducing his benefit by a single dollar. Even better, without him knowing or approving. In the next video, I'm going to walk you through exactly how the 10-year rule works, who qualifies, and what it means for your retirement timeline, and the one mistake that disqualifies you permanently. When you watch that video, you will understand why this benefit is one of the most underused financial advantages a divorced woman has. I'll see you there.